Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include some notes about the big, beautiful bill, my interview with Pennymac's Kim Nichols on the current state of the broker channel, market dynamics, and strategies shaping the future of third-party origination, and what sort of range we expect to see for U.S. Treasury yields throughout the rest of the summer. Are you looking to cut verification costs by up to 50% while improving borrower experience and pull-through? TrueWork helps lenders streamline income and employment verification through a single VOIEA platform used by 4 of the top 5 lenders. With an industry-leading 75% completion rate, the platform consistently outperforms competitors in manual waterfalls in speed, cost, accuracy, and rep and warrant relief. They also offer free pre-approvals to help your borrowers qualify faster, and only pay when a file is completed. It's used with first and second liens as well as in wholesale. It's fast to implement, easy to use, and built to drive ROI. Learn more at truework.com. Lenders and servicers have entire sets of policies and procedures based on the Federal Emergency Management Agency, or FEMA, declaring an emergency in a given area. President Trump says FEMA should be eliminated, which would definitely impact this process. Texas officials weren't fans of FEMA until they needed it. Unfortunately, FEMA has become politicized. Generally, how does politics work, regardless of political party? Well, President Trump's spending bill package was in trouble, and it needed Alaska Senator Murkowski's vote. And that's how 150 Eskimo whalers saw a 5-fold increase in the amount they claim in expenses against tax every year. And the subsidy for Alaska's rural hospitals was doubled from $25 billion to $50 billion. Meanwhile, professional poker players and sports bettors are demanding a change to the massive tax and spending bill since it changed the way gamblers deduct their losses on their taxes. Currently, gambling winnings can be offset by 100% of gambling losses. But the deduction will be lowered to 90% of losses in the new bill, which professional gamblers and tax professionals say could lead to taxes on an income that gamblers did not earn. So if they won $100,000 and lost $100,000, they still owe money on the $10,000 because only $90,000 can be deducted, said Representative Dinah Titus, a Democrat representing Las Vegas, who introduced a bill this week to reverse the tax change. Getting back to mortgages here a little bit, after a quiet couple of days to open the week outside of tariff headlines, yesterday packed some market-moving potential with the 10-year Treasury auction and the release of the June FOMC meeting minutes. By the end of the trading session, bond prices unexpectedly rallied as there was renewed rate cut optimism stemming from chatter about possible replacements for Fed Chair Powell when his term ends, signs of decent dollar demand at the 10-year note auction, and the FOMC minutes for the June 17th and 18th meeting conveyed a stronger expectation of rate cuts before the end of the year than no rate cuts at all. The Fed minutes revealed concerns that tariffs could push inflation higher for longer, potentially shifting expectations. A rate cut this month now looks unlikely, and even a September cut is being debated, depending on upcoming inflation data. For now, the market seems to stay within a stable range. The true inflationary impact of the tariffs may not be fully visible by the September FOMC meeting. However, the Fed will have 3 additional CPI prints and greater clarity on the final scope of the trade measures by then. So far, inflation data has not suggested a return to the elevated 2022 and 2023 levels, and the Fed appears to have successfully re-anchored price stability. While fears of a reflationary shock linger, the lack of realized inflationary pressure may soon shift the narrative around the trade war's effectiveness. As for today, market attention will remain on any fresh trade updates and how foreign partners respond. But risk assets are largely taking the situation in stride. Much like the budget and deficit concerns earlier this year, which sparked selling ahead of resolution and buying once finalized, the trade tensions may end up having a muted and delayed impact on yields unless economic data confirms a real spillover. This could potentially cap Treasury yields in the near term. For today's interview, I wanted to welcome to the show Pennymac's Kim Nichols to talk about the current state of the broker channel, market dynamics, and strategies shaping the future of third-party origination. She's Chief Third-Party Origination Production Officer and oversees all broker and non-delegated correspondent production at Pennymac. She offers over 30 years of expertise in various mortgage financial service areas, including capital markets, operations, underwriting, and credit across all production channels. She's been at Pennymac since 2011.
I'm very pleased to have you on today. And before we kind of get into some of the specifics at Pennymac, which I know people would love to hear because Pennymac's such a important player in the TPO space, can we talk high level what's going on with the TPO channel? Obviously, a lot of people that listen to this podcast or read the commentary aren't intimately involved in the space, and maybe they'd hear like, oh, well, margin compression in the wholesale channel, whatever. How would you describe the current environment right now in the TPO channel? Kind of bring people inside the
Yeah,
loop.
so the channel remains, extremely competitive. I think you're aware it's dominated, today by two major players. But everything Pennymac is doing right now is surrounding growth, and we want to become a more dominant player in the channel. And everything we're up to is driving growth, market share growth, partner growth, depth of relationship with partners. We are continuing to invest forward in the channel. We want to achieve even greater scale. I mean, we've grown a lot, but we want to continue to achieve even greater scale because scale is going to matter in this channel, and we've seen that before. So we're investing in people. We're growing our team. We've expanded our sales organization considerably. We've bolted on tremendous operational capacity and just continuing to invest forward in our growth in multiple ways. We're also differentiating ourselves through our proprietary technology, and competitive pricing, focus on our relationships with our partners, really staying in tune with them. And I like to say, Pennymac is tech forward and human focused because you can have the scaled data-driven workflow, but you have to focus on the human aspect of these relationships. And you're working with independent loan officers working, by and large out there by themselves in this space, and they need to lean on their partners. So we want to be a good partner in that regard as well.
You mentioned a ton of strategic initiatives there, which is great. And I want to ask though, I mean, there's also the elephant in the room, which is those large two players that are continuing to do everything they can to gobble up market share. For other companies in the TPO channel, and obviously Pennymac has a sizable market share. There's another group of lenders right behind those first two, and I would include you in that certainly. What does it take to win business in today's environment? What's this? Obviously, you mentioned a ton of different things in the previous answer, but when it comes to getting through to brokers or offering the most competitive products or the experience, what are you doing, or what should companies in general be doing in the TPO space to win more business up against these two giants?
Right. Of course, pricing is very, very important. But as a loan officer, you go out, you can pick the partner with the best price and then fail on execution. You lose a referral partner. Speed is probably the greatest need in the channel. It's what we hear every day. Speed to certainty. We're running about 80% purchase. I think the TPO channel's right about that. So heavily purchase market. I talk to LOs, and it's just so very intense for them, the market that they're competing in, the expectations of referral partners, taking on, tight COE dates with very tight contingency periods. We need to be right there with them. So it's all about speed to certainty. So everything we do around process, enhancing our platform, technology, we're trying to support the need for that speed to certainty in that referral partner relationship and driving to these very tight close of escrow dates, tight contingency periods. I mean, I feel for the independent LO out there. They are under just a ton of pressure due to the expectations of their referral partners. So as we look to solve for speed, we also have to execute with transparency. We have to keep communicating because why? Because those agents are all over our LOs. What's going on, with the Chrisman loan? 10 minutes later, what's going on with the Chrisman loan? Like, it's just so intense for them.
The Chrisman loan failed the ability to pay requirements in underwriting. So that's what's going on with the Chrisman loan.
So we have to have great communication, transparency in our tech as well. And, we're depending a lot on tech to enable that. But again, we wrap that with a human touch because sometimes you just can't look in a system and understand everything that's going on in such a complex transaction. Also, if you think about the, independent mortgage broker model, they're sitting out there without really much infrastructure. It's an infrastructure light business model. And so they're really depending on their lender partners for a lot of different things. So, aside from just that speed to certainty execution on every transaction, they need support with, training, product training, understanding how to calculate income. Yesterday, we had a webinar about variable income calculation and how to do that, and we had over 500 participants, LOs, and processors from the channel on that call. So it just shows like the need for education, training, support, and then also, we have a marketing platform where loan officers can go in and create open house flyers, various things that they want to market, whether it's on social, living at open house, email templates, things like that, that they can leverage. So they do need also a partner with infrastructure support, which we are also, building and providing to our partners.
Yes, I'm going to lump a couple questions together here because that was such a comprehensive answer. And I'll ask, speed to certainty is a great phrase, and I really like that. In general, it's, brokers navigating today's environment, what support can you provide? And at the end there, you mentioned infrastructure, which is obviously key, speed, infrastructure, anything else. How companies can invest in their brokers, which I think is very important, and we're seeing a lot of more successful companies do that. And then we can talk Pennymac a little bit, kind of the advantages you feel like you have over the competition as a result of those first two things.
I think that, some of the advantages we have over our competition, start with our investment in tech and building, a really great comprehensive tech platform on which our partners can operate. We also, because of our scale, because of our capital markets capabilities, we have very sharp pricing. We're very competitive in pricing, across the products that we offer. Today, we've made really big strides on the non-agency space. So we have an AUS jumbo that is kind of leading in the TPO channel. We have a fixed rate home equity product that's very, very strong. And so, we're just investing in all of these capabilities so that collectively we're delivering a very strong value proposition. One of the things that our partners really, really like is the fact that we retain servicing. So I think, we're one of the largest servicers in the country, and we are just one of the few in the channel that makes a permanent capital investment in servicing. So loan officers really appreciate that continuity of service after closing. And we all know servicing transfers can create confusion for borrowers and service gaps. Borrowers have to set up a new ACH. It's kind of a hassle. There can be, escrow fund discrepancies. So the LOs, have confidence that post-close is going to be very smooth for their customer. It also offers them, further advantages. If there's a future refi, we can allow net escrows on Pennymac refis for them. We offer a partner signals program because we're retaining servicing. We can look for signals as to whether or not that consumer is in the market for their next mortgage, and we pass those signals along to our clients so that they can get in front of a potential, refinance or new purchase, whatever the case may be. So this is definitely creating advantage for Pennymac, kind of a unique advantage for us.
Very cool to hear. A lot of the discussion on this podcast I have with people is centered around advancements in tech. And we are kind of going through this tech revolution out there with all the artificial intelligence or machine learning. Obviously, the concept of a fully digital mortgage or end-to-end digitization has been around for a while, but it seems like right now is a really pivotal moment where companies are getting left behind if they're not investing in technology like their competitors might be. And so when it comes to the TPO space, what recent advancements in technology have been game changers? What's kind of the pinnacle of technological experience, whether it's that you want to offer to your broker partners or ultimately their clients? Where are we with technology in the TPO space?
Again, it's just critical, and tech has enabled the growth of the channel. Without tech, we wouldn't be seeing the TPO channel grow as it is. So it's table stakes. And then I also have the belief that tech is never ending. You have to constantly be innovating, and so that takes investment and cost. So that's where scale is really important as we're building this TPO platform and continuing to build. We have to continue to invest in technology. You're not just like, okay, I wrote that check, I'm done. It is continuous because, like you said, the pace of change and the pace with which tech is going to drive our industry is just tremendous. So we're committed to that, and we're continuously trying to improve upon what we have. More recently, we launched our non-Del Plus platform, which it's built upon our existing Power Plus broker portal, and it's a full service non-delegated solution. So previously, we were operating non-Del exclusively off of our P3 platform, which is our traditional delegated platform, but we had built on a non-delegated offering onto that platform, and that served well for clients that could do their own docs and disclosures. But we needed to build a scalable solution for clients that really don't have the infrastructure to build their own ability for disclosures and closing docs and things like that. And so we built non-Del Plus off of the Power Plus platform, and built in a lot of guardrails so that more it really opened up a brand new client segment for us, of that client who's making the transition maybe from broker into, hey, I want to try this correspondent thing. And it's got a lot of built-in elements to protect our client, and from a compliance perspective, and they don't have to go out and hire their own doc drawers and closers. They can do it all within the technology that's enabled through our platform. So that's just a really good example of continuing to enhance, invest in tech, and that program, which was launched pretty early this year, is really getting some steam and growing. I'm really pleased to see that progress.
That's cool to hear. Definitely cool to hear. Before I let you go, I'm going to ask you to pull out your crystal ball a little bit. And I say that because if we look back to the early 2000s, banks dominated the wholesale market. WAMU was huge. Wells Fargo was huge. There's Bank of America, Chase. That's evolved. And we've seen, some of these large, what do we call, Michigan lenders take a lot of market share in the wholesale space. And the companies now are trying to solidify their position. We've seen acquisitions of servicing books. We've seen acquisitions on the front end of the origination process too, when it comes to realty shops, things like that. How do you see the channel evolving and shifting? Kind of where does it go from here?
There's a lot of recent market news out there where you're seeing big shifts with large IMBs. Again, we think this channel is going to continue to grow. It's part of why we're here, right? And investing. But I think our time has really come in this channel. I think that recent news underscores the need for another strong partner stepping into the TPO channel. I think some of the partners out there may be fatigued by some of the competitive tactics in the channel, and they're looking for a partner that respects their autonomy, won't compete for local referral source business. retained servicing, with a non-solicit commitment for 18 months, those kind of things. I think that the time has certainly come, given, the backdrop that you just laid out with some of the recent activity. The time has come for another partner in the channel, and we're there to be a great partner and continue to help our partners grow.
Awesome. Glad to hear it. I can sense your enthusiasm for doing it. Certainly an interesting time to be in mortgage. And I should have had you on the podcast a long time ago. So I appreciate you making the time, and I look forward to having you back in the near
All
future.
right. Thank you so much for having me. Appreciate the opportunity, Robbie.
The government sold 10-year Treasury notes at a yield of 4.36% yesterday, slightly better than expected. Investors, especially direct buyers, showed above-average interest, and overall demand was solid. U.S. Treasury yields have hovered near the top of their recent range, with the 10-year note anchored around 4.40%. Despite speculation about a potential buyer's strike, auction demand has remained steady. The recent rise in yields from early July lows reflects a reasonable concession surrounding supply and has brought 10-year Treasuries back into a more attractive valuation range. While the latest round of tariff announcements has added some market noise, the more meaningful drivers of recent yield movements have been a stronger than expected June jobs report and the aggregate auction supply. Weekly jobless claims led off today's economic calendar. Initial claims were at 227,000 with 1.965 million continuing claims, kind of more of the same that we've seen recently. Later today brings some Fed speak from St. Louis Fed President Musalem, San Francisco Fed President Daly, and Fed Governor Waller, Freddie Mac's primary mortgage market survey, a Treasury auction of $22 billion of reopened 30-year bonds, and the New York Fed's buyback in 5 to 7-year coupons for up to $4 billion for liquidity purposes. We began Thursday with agency MBS prices unchanged from Wednesday's close, the 2-year yielding 3.86, and the 10-year yielding 4.35 after closing yesterday at 4.34%, with long-term bond yields hovering around 4.4 to 4.5%. Many see this as an attractive level to lock in long-term returns, especially if the Fed holds rates steady at its next meeting. Let's wrap up with a joke and some housekeeping. What should we do with people who rely on government handouts but refuse to work? Kick them out of Congress. Thanks again to TrueWork, the only all-in-one automated VOIEA platform that helps mortgage providers achieve up to 50% cost savings with an industry-leading 75% completion rate. To learn more, visit truework.com.